Hey everyone, we just launched a really cool new feature called Dealer Market Diary, and I wanted to make a video to quickly talk about it so that if you're looking at this widget, you can understand what it does. I really like it. I think it's pretty cool and I think it's very, very useful. So let's talk about it. Before we do that, please know that this is not investment advice. We are a data vendor, so all we are doing is showing you really useful data. But without further ado, let's actually dive right into what the dealer market diary is. If you want to go to the dealer market diary, just go to the options market dashboard, and then if you go down, you are going to see the dealers market diary and then the hedging dynamics. So let's quickly talk about these. Why do we need them? How are they useful? And all things related to that. So the first thing that we need to know is how does hedging work. So we have talked about this in other videos, but anytime you buy a call, there is a market maker or a dealer on the other side of a call, which sells you that call and they want to stay delta neutral. So when they sell you that call, now they have a bearish position because selling a call is a slightly bearish position. So in order to hedge that position, they are going to, since they are bearish, they are going to buy the underlying, and that's how they stay delta hedged. Let's say you buy a put. Now the market maker is actually selling you a put, which means they are bullish. Now that since they are bullish, they are going to actually short the underlying in order to stay delta hedged. And then there is gamma hedging and all kinds of hedging, but that's the basic principle. And we are going to stick with that just to keep things simple and just to keep this video short. So that's what we know market makers have to do when customers, like people like us, people like retail traders, are buying or selling these options contracts. The market makers have to provide liquidity, but while they're providing liquidity, they want to stay delta hedged. They do not want to have a directional risk. That's pretty cool. So when a lot of customers are buying calls, since market makers are selling those calls and then they have to buy the underlying, that can cause a momentum effect, or that can cause the price of a stock to, let's say, go up. Some of that actually happened with GameStop and AMC, where customers or retail traders were buying tons of calls and then market makers had to sell calls, but then they had to buy the underlying. So that created a pretty nice momentum effect and price went bonkers. So that's what happens when we are buying or selling a contract. That's what happens right away. But there is another side that we're going to talk about today that often gets missed. And so at the point of trading a contract, the market maker has to provide us liquidity. That's all good. We understand that, and we have quite a lot of videos on how to leverage that. A really good way to leverage that is to use DEX or market net flow, which actually shows you sort of the sentiment of customers, which can then help you predict market movements. But we want to talk about something else today, and that's what happens when all of these contracts that customers or retail or institutions or hedge funds are buying or selling, what happens when those contracts are about to expire? That's a question that's very interesting, and we are going to explore that today. So in summary, let's say you buy a call, and you buy a call, the dealer has to sell you a call. When the dealer has to sell you a call, they're going to buy the underlying in order to stay delta hedged. But once that call is expired, or once that call is close to expiration, the delta of that call is going to the delta of that contract is going close to zero, as long as obviously it's out of the money. Now when the delta of that call or put contract is decreasing, considering or assuming out of the money contracts, these market makers have to go out of these positions that they bought or that they sold with the underlying when they initially traded that contract. So when initially they sold us a call and they bought the underlying, once that call expires, and let's say it stays out of the money, it expires worthless. Now all the bought shares that they had, they need to sell those shares. And that's the core of what dealers market diary tries to do. And that's the core of what we are going to analyze here. So what the dealers market diary is showing you here is how many puts and how many calls are expiring on different expiration dates in the future. Anytime you see a green bar that is positive, that means customers customers are net positive, or customers are bullish, or customers have bought that many calls, and dealers are short that many calls. So these green bar, if it's above 0, that just means dealers are short 0.2 billion deltas worth of calls. So this chart is customer sort of deltas, but we are actually going to infer the dealer deltas from here. Keeping customer deltas on the chart just makes things easier. Now anytime you have this red line, this is puts. So anytime the puts bar is below 0, that means customers have actually bought a lot of puts. So calls have to be above 0 in order to be considered bought by customers, and puts have to be below 0 in order to be considered bought by customers. Now since puts are below 0, this means market makers are short 1.23 billion deltas worth of puts that are expiring on 19th September. Now that we know that, what can we infer from it? So what happens, and these are deltas for the entire market, not just for SPY, for SPX, for QQQ, literally the entire market. And what happened was we wanted to use these deltas to infer market movements, but what was happening was we have different kinds of indices, QQQ, SPX, SPY, so we couldn't figure out which one to use to actually nail market directions. So the idea was like, how about we use the entire market, and that's what we are doing here. So now yesterday was September 19th and today is September 20th, but yesterday we can see we had massive amounts of put positions where dealers were short puts, and remember, when dealers are short puts, they are long the underlying. Sorry, when the dealers are short puts, they are bullish, so they are short the underlying. And so dealers were short a massive amount of shares in the overall market for stocks across the entire market, and all of those contracts were going to expire yesterday. So what probably happened yesterday was, since all of those contracts were going to expire and dealers had these huge short positions because of all the puts bought by customers, dealers had to unwind those positions, which means if they were short, they were going to cover and they were going to buy those shares back. When that happens, that's where the magic happens, because now the dealers, like having billions dollars worth of positions, are actually unwinding their positions. And since we know that the positions were massively put positions where dealers were actually short the underlying and they have to buy back in order to like de-hedge or in order to unwind their positions, we can use that to infer what might happen today. And we can actually see that, let's assume that dealers did all the de-hedging towards the end of the day. You can actually see that the flow, the options flow for the day was almost 0 towards the last half of the day, but we still had a pretty nice squeeze from 384 all the way to 389 or around 390. What caused that? The flow for yesterday, or the flow for September 29th, did not cause it, because we can see that the flow for the entire market, which is what market net flow measures for that particular day, was almost non-existent. It was 0. So then what could have caused this move? Now we are assuming that since dealers had a very huge position that was expiring yesterday, and since they had to sort of cover all those short positions that they had with the underlying, we are assuming that the move was actually caused by dealers having to cover their short positions. Obviously, that's just one example, and we are actually looking at historical data to make assumptions, but that's the assumption. I think that's a fair assumption, and I think that makes sense. Hopefully it makes sense to you as well. But that's how you can use these bars, and this was just for yesterday. We can actually see that contracts over the next 1 or 2 weeks are still put dominant, which means over the next 2 weeks, people or customers are well hedged because they have bought massive amounts of puts, and dealers are short puts, and which means they are short the underlying. So once all of these contracts expire, we are expecting a smaller run up to the upside again, as long as what we are saying and what we are talking about is true. Obviously these bars can change because this data is updated every 30 minutes, but I hope that makes sense. Now once all of these contracts expire, then we can see that these red bars are not that big to the downside anymore. So then other things might happen, but by that time we'll have more data, so we'll know what to expect. But if this is too difficult to you, we have made it easier with the chart on the right, which is the hedging dynamics. Now we have a bunch of correlation charts here, but I think this one is the most important one. You don't really need to understand these two, this one sure, but not this one, like to a great extent. If you just want to skip that, you can. But this hedging dynamics actually shows you what happens when these bars over the next 1 or 2 weeks are red, what happens when they're green, and what happens when the difference between them is large, small, or whatever. So each bar here, each scatter plot or each point here is the green, the value of the green minus the value of the puts. So the value of calls minus the value of puts. This would be 0.5 minus 1.5. So not minus 1.5. Actually, consider it positive because we are just converting it to a negative sign in order to make it visible, in order to make it clear. But 0.5 minus 1.5, that's about minus 1 billion net put delta, because calls are very small. Customers have bought smaller number of calls, but they have bought massive amounts of puts. So that means that the net delta for calls and puts for customers is actually about minus 1 billion to the negative side. What has happened in the last 2 years when this has been the case? And now that's a very nice question to ask, and we are going to answer that question with the chart on the right. So each point is what happened when the total deltas, the net deltas, were some value, so minus 5, let's say. What happened the next day? And you can see that as the total net delta, this is not just total deltas, it's actually total net deltas. As the total net deltas moved towards the left, which means as these red bars got bigger and bigger, price actually moved up, or the probability of an upper move was much higher than the probability of a downward move. The probability of a downward move, again, the y-axis is the 1 day future price change. The probability of a downward move was much higher when the total net deltas were positive, which means customers had bought a lot of calls or they had sold a lot of puts. In both cases, dealers would have the total net deltas would be positive. And so that's interesting because today, again, we had very bearish price action over the last few days, but today we had some support. We made a nice $8-9 move. We could have used this chart to gauge the probability that an upside move is slightly more probable here than a downside move, especially if this orange is where we are at right now. If this orange was let's say to the very right, -5, -10, then we can see that there have only been a few instances of a down move, but those down moves have been very small. Why is that the case? Because again, since dealers are sort of buying back all these shares, even if the market goes down in general, dealers are going to provide support. So that's very, again, useful to know. But if the market is going up, then the dealers are also buying their shares back, then they are going to actually provide momentum to the market, and that is what you are seeing here. So anytime we have these huge negative net deltas, you can see that we had pretty nice large upward moves. And I've talked about all of these assumptions, but this is where the data driven part of our platform comes in. We are not very subjective anymore. We are trying our best to be just a data driven platform, and this is data showing you how dealers or how unwinding of positions for dealers can impact the price of SPY or of the entire market. Now that's just for the 1 day change. What if you want to see what happened when we were, let's say, at about -2, -1 deltas for the next few weeks? So if you go to the parameters, then what we are seeing here is show me the net deltas where all contracts less than 7 days till expiration are considered. We are not considering all of these expiration dates, only these one, because these are the ones that the market makers have to unwind first before these times arrive, because again, these are expiration dates of contracts. So they don't really care much about these, all of these. They really care about this bar, this bar, this bar over the next 1 or 2 weeks. So let's just keep contracts within 7 days till expiration, and then show me the future 1 day change, and then show me a correlation chart. And that's what we get here. But what if I wanted to look at these weekly expiration contracts and see how they impacted, or how their unwinding impacted 5 days future change? If you do that, you can draw that, and you can see that as we moved towards negative net deltas, the moves on the positive side, or the upside moves, got pretty big. But as we move towards these slightly zero or slightly positive net deltas, which means green bars are going to get bigger and these red bars are going to get smaller, or these red bars are actually going to go to the upside. So instead of being negative, they're going to become positive, which would mean customers are selling puts and dealers are buying puts. When that happens, you can see that price has gone down in just 5 days. There has been instances where SPY has gone down about 10 to 12%. Now that's a very massive move for SPY, and that was caused only when dealers were also supporting the move, because when dealers are net positive deltas and when they are unwinding those positions, the net positive deltas actually means dealers are long the underlying in a majority amount. So once they are long the underlying, and once those contracts expire, they have to sell all of those contracts. And when, or if price starts to go down, and then there is all of this selling by the dealers as well, then that can cause a momentum effect to the downside. And that's what we are seeing. That's why we are seeing all of these down moves. Again, below zero is the 5-day future price change. You can see most of those moves happened when dealers were positive net deltas. Now I don't know whether you think this is cool or not, but I think like this is pretty magical to me, because we have like full access to how dealer positioning is looking. At least we can approximate it, and we have a correlation chart of the past, and that correlation chart is not like totally random. It's showing us clear patterns, and those patterns are, as total net deltas get negative, dealers are going to support upside moves. As total net deltas become positive, dealers are actually going to support downside moves. So maybe that's what we should be playing, and if there is any move against that direction, then we can expect the dealers to provide support against that move. Again, that is pretty cool to me, because like I really want to stay a data person, especially with our platform nowadays, and just being able to use data to derive such beautiful insights is really cool. I hope everything made sense to you, but even if it didn't, please let me know. Please ask questions in the comments. Let's learn together. Let's use this together. Again, please know the difference between DEX and the market diary, the dealer's market diary. DEX is what's happening by customers today. Dealer's market diary is what's happening with contracts from customers that they have been buying or selling over the last 2 months. Like how have dealer deltas been developing, and what's going to happen once those contracts expire. DEX is actually all the flow from today. These deltas, like the diary, is from the last 2 or 3 months of deltas built up. So these are different things. Now, how do we combine DEX? How do we combine market net flow, market DEX, and dealer's market diary? That's a question that we yet have to answer. This is a very new widget, so I'd highly advise you to only use it for experimental things. Do not use it to make plays right away. The theory is pretty clear. You have the data evidence, but let's actually keep looking at it and keep using it for a few days to gauge market directions or to gauge overall trends. And then we can actually start using it to make actual plays. If you want to go back, one thing that most people want to do is actually they want to go back and see how this chart looked at some other date. So you can just change the days ago, and you can draw it again, and you'll see like now this chart is from 14th September and not not from today or yesterday. So again, please spend some time with this chart. See if you can understand it as well. See if you can find these patterns as well. We have all these settings that you can try. This -1 is a tricky one. So what if you want to ignore all contracts that are expiring within 7 days and then look at contracts that are expiring after 7 days? Then instead of selecting 7, you select -7. So that's going to ignore all contracts. Instead of including all weekly contracts, it's going to now ignore all of them. And I don't know like why people would want to use it, but I still wanted to give all options to our users. Again, I hope this made sense. I hope you like the idea. I hope you'll spend more time testing it out, just analyzing it, and I hope you learned a few things in this video. Thank you so much for watching this. I will see you guys around.